Welcome to Invest Well, Be Well, a podcast for wiser investing and stronger living. I'm Rusty Vanneman, longtime investment professional, and I'm joined each week by my co-host, Robin Murray.
Thanks, Rusty. I'm a storyteller and journalist, and I am so excited to explore the ideas, insights, and people shaping the intersection of performance and purpose.
This podcast is for thoughtful investors and driven professionals who want to grow in their portfolios and in their personal lives.
We'll talk long-term investing, behavioral finance, personal development, and what it takes to live and work with intention.
So let's get started. Let's invest well and be well together.
This podcast is brought to you by Main Management LLC. Since 2002, Main has been recognized as an ETF strategist that combines an institutional process with the personalized service of a boutique firm. Our guest today is Tom Lydon. He's the founder and head of Global Trends Investments. And that was a pretty cool interview, some interesting stuff.
Absolutely. I mean, Tom Lydon, he is really a pioneer of the ETF world. And as I say in the podcast, he is an OG of the ETF ecosystem. He's also a dear friend, and he's a fellow Babson College alum. And we go over his career. I mean, Tom really, his career began at Fidelity, but it included founding Global Trends Investments. In 2005, he co-founded ETF Trends, which later merged with ETF Database, eventually evolved into Vetify. In short, he's helped shape ETF education, research, and innovation globally. He's an author. He's a trustee on fund boards. He's a media commentator. He's really a genuine industry luminary. And besides his expertise, I think he really knows how to live well. He's got a bi-coastal lifestyle, a love for family, and plenty of stories about his early years. It's just great. What are your takeaways?
So yeah, some of what he said about his family I thought was really interesting. He talked about some of the financial planning that they do together. They have these quarterly family meetings and everybody is sort of on the same page and they have those discussions openly, which I just think is great advice for everybody. And I'm sure there's not that many families out there that are doing that kind of thing and having those open conversations, which, is probably a good idea for everybody. And then he also talked about having a 120-page to-do list, which I thought was fascinating and terrifying. And I'd really like to see what's on there.
Well, I agree. So, I mean, he had a lot of great answers, but the answer on kind of living well, just so many little nuggets in there. And you touched upon some of that. Again, he is an ETF expert. And so whether you invest in ETFs or you manufacture ETFs, he had stuff to say. And it came just to investing, just general best practices for investing. So love this interview. Again, he's a dear friend. It was a lot of fun.
All right, let's listen. Well, hi, Tom. Welcome to Invest Well, Be Well.
Hey, Robin. How you doing? Hey, Rusty. Great to be here.
Well, Tom, this is really great that you're here. And we've done a few of these over the years, and they've always been great. We have a lot of great questions for you, but our very first question is the most important one. And that is, we need a walk-up song to set the tone for this interview.
Yeah. So when we did this years ago, Rusty, I had Dropkick Murphys. I'm shipping up to Boston. You being from Boston, I'm sure you know that one. And I'm sure I'm not the first one to pick it either. But it's one that meant a lot. But now, as I'm in the later stages of my career and what I'm doing, I got something a little bit more modern. There's a newer singer, Lola Young. She's got this song called Messy. It's got a couple F-bombs in it, but it's still kind of a fun song. And it's just a reminder that no matter how hard you try, you're not perfect. So I like hearing that from time to time. And kind of do your best and have some fun along the way. That's what I got from it.
Yeah,
that's right.
It's nice. We've had F-bombs before. They're usually with friends and stuff like that. But anyway.
That's great.
Yeah.
You know what? We do have a playlist. I think I'm going to put Dropkick Murphys on it anyway because it's such a great song.
It is. Yeah. And you don't want F-bombs on your podcast. So I could have picked something different, but, we've known each other long enough. I can be honest.
It's a great start. Awesome.
All right. Well, Tom, so you have really had a remarkable run in the ETF industry, from launching ETF Trends to your work today as a strategic investor with Vetify and your podcast, as you mentioned, Bangers Only. So if you had to describe your career journey in a single sentence, what would that sentence be?
I would say most people admit, at different times of their lives, they ride different waves. I chose to ride the ETF wave early, and it was one of the best decisions I ever made. Fortunately, along the way, that wave just got bigger and bigger. And still to this day, the ETF wave continues to run. I'm not saying that I was really smart or by far one of the smartest people in the ETF space. I was just early, and I stuck to it and hung on by my fingernails, and it's been a great ride.
That's awesome. So what drew you to investing in general and more specifically to ETFs? Was there a moment or a person early on that really shaped your philosophy?
With most people, I think, with their careers, Robin, what they plan doesn't usually happen, and what usually happens is something that you didn't plan. So again, Rusty, I graduated from our collective alma mater, Babson College, in 1982. Go Beavers. So just for people, 1982 was not a good year for the economy. Interest rates were 17%. Unemployment was in the toilet. And we were in situations where everybody was struggling to get a job. I was very lucky that by graduation, I had signed on with Richardson Vicks, the cough drop company, Vapor Rub, NyQuil, all that. And I had a expense account. I had a car. My first territory was Westchester County, Queens, and Harlem. And I learned a lot in that period of time, and I did pretty well. So much that I got a promotion to Western Wisconsin, Minnesota, and North and South Dakota. Much bigger territory. My manager at the time said, you got to get some things for the trunk of your car. You're going to need a snowmobile suit. You need food rations. You need a telescopic flag, and you need a portable heater. I said, well, why is that? Well, it takes you 10 hours to drive from one end of your territory to the other. And guess what? It snows up here sometimes. So I went through a period of time, and then I called an old friend. While I was at Babson, I had an internship at Prime Computer in Human Resources. He had moved over to Fidelity Investments, and I called him and I said, hey, do you have anything available? And he said, do you know what a mutual fund is? And fortunately, my dad was a broker. I knew what a mutual fund was. He said, when can you come to Boston? And I was coming home for Thanksgiving, and he got me an interview, and I ended up getting a job at Fidelity. I miss the people in the Midwest. They're the nicest people in the whole world, but it was nice to get back on common ground in Boston, and it was really a thrill to be part of Fidelity early on. So that was something that hadn't been planned, but it ended up working out pretty well. And then fast forward, as I worked for an advisor and ended up starting my own advisor out in California, using trend following models in mutual funds, we found that the fund companies enjoyed when you bought their funds and you tell them that you're a trend follower, but you also tell them when you're going to sell when things go below the trend lines. They didn't like that. So I ended up making a few friends that weren't friends anymore in the business, and I needed an alternative. And I heard about these things called exchange traded funds. And by that time in the early 2000s, there were enough representation with the major market indices that I could actually go in and buy and sell when I wanted to. I didn't have to ask mom or dad for permission to buy or to sell. And sure enough, that group of ETFs continued to grow over time. And I just built my advisory business on using portfolios made of ETFs for clients.
Yeah. Boy, I didn't know some of that story. That's great. So, Tom, you mentioned you've been at the front lines of the ETF evolution. And actually, I would consider you part of the OG of the ETF ecosystem for sure. And so you've seen a lot. But what do you see as the next big chapter in the ETF space for both investors and ETF providers?
Well, thank you for that compliment. Somebody called me once the Rip Van Winkle of ETFs, so I'm glad you didn't go that far, Rusty.
OG is cooler.
It is definitely cooler. You don't get as many naps, but okay. So when you look at the ETF space, and it's like mutual funds, it's like stocks, most advisors have some form of a 60-40 allocation. And what they'll also do is they'll have satellite positions, they'll have overweights in certain areas. They may put a little bit of hot sauce. They may do some trend following or timing. But I think in most cases, when you look at most advisors, they kind of fall into that category. If you dig into the flows, and this is ETF flow analysis in the last couple of years, most of the money has been in large cap US, growth, value, blend, fixed income, short duration. And this is consistent, not just month to month, but almost week to week. But there's been an area, it's not the crypto area, but the covered call buy right area, enhanced income, synthetic income. Everyone's got different names for it. But there are a bunch of new strategies that are out there, all active in nature, that produce wonderful monthly dividends above average of what you're going to get in the fixed income marketplace. But they're all have core equity or fixed income core indexes that are tied to them. The neat thing is there are a ton of choices. They're all different. And the way that they get that income is different depending on what options you buy. Some are very tax efficient. Some are not tax efficient at all. And when you look at the biggest active ETFs in the marketplace, JP Morgan's equity premium income, JEPI, JEPI, it's the biggest by far in this space and just continues to grow. So what we're seeing are advisors are now allocating to these types of ETFs in a core. And what it's doing is obviously enhancing the dividend return, but it's also providing less volatility as these products on the equity side aren't as volatile. And I believe we're just getting going. There were some reports out through BlackRock that they feel that this group, now that's approaching $200 billion, may be at $600 billion in the next 2 to 3 years. And when you look at the flows, you'd have to agree that there's something there. Unfortunately, it's not as sexy as crypto, and crypto isn't getting as much money in this space. But I'm looking at the league tables probably the same way that you folks are and the flows, and synthetic income is one of the hottest areas in the market right now.
You can call it synthetic or derivative or enhanced, and you're right, the flows in the first half of this year have been gangbusters. And you're right, you got to do your homework because they all do it a little bit differently as well. So my next question is, I just looked at these numbers to make sure I had it right, but as of the end of June, there are now 4,000 ETFs in the US, and that's not including global ETFs. So given all those ETFs, what separates the winners from the rest? So in other words, what does it take to build a successful ETF in today's market?
It's hard. It's a rock fight. It's really, really difficult. So today, if you're starting a new ETF or a new family of ETFs, first of all, you need a unique idea, or you need to bring your own money. And there are a lot of companies, big asset managers, that are getting into the ETF space for the first time. To some degree, it's a defensive move. They're under peer pressure by their boards to make sure that that offering is there. Again, some managers who put up big numbers over the years don't like having to open up the hood every day to show people what they're doing. And they're not going to make any headway using traditional indexes because that land grab's already gone. So what they're going to do is they're going to take their investment methodologies and style and use similar in offering their own ETFs. Many can do well if they have SMA accounts. So you're seeing this SMA conversion wave that's happening too. It's really good for the tax efficiency. You can offer it for less expense. It's easier to manage. So we've seen a wave of big asset managers converting their SMA business to ETFs, and that gets them in the game. That's great. Also, you've heard a little bit about this ETF share class rule. It's very potentially going to be confirmed by the end of the year. And that would mean that if you have a mutual fund, you're going to be very easily allowed to offer up a ETF share class under that same fund. I think that's going to be game-changing for those that have successful funds and they're not in the ETF business. But Let's just say you don't have that. Let's say you're an advisor or you're an asset manager and you want to get into the space because you believe you've got a great strategy. So if you're starting from scratch, a couple things. A, you have to have something unique that nobody else has. And that's really tough because not only the index land grab has happened, but also we've seen an active land grab out there, okay? And you're going to compete with the big boys because if you do come up with something unique and it gets some traction, guess what? They're looking out there and they're going to come on your heels pretty quickly. So good idea, first mover advantage, count a lot. You have to have some type of brand that people hopefully pretty easily can recognize. It's nice to have some media or a talking head behind it. You have to have social media as well. Self-directed investors are really, really smart, and they are all over social media. I don't have to tell you guys. They're watching all the social media platforms. They're watching YouTube. They're trying to get the next best idea and listen to smart people like you folks. So that doesn't mean that you're going to be successful, but there will be success stories out there. But I have to say, betting on new entries into the space that don't already have assets or are going to bring assets, it's a tough grind. It really is.
So what do you think you would say the habits or the characteristics are of successful long-term ETF investors? What do they get right that others miss?
So look, one thing that age gives you is experience. And I would say one thing I learned over time is it hurts when you shoot yourself in the foot in your portfolio. Your ego's too big. You think you can be a stock jockey. You think you're good at timing the market, that type of thing. And there's so many of us, if we're honest, admitted that they went through that period of time and they failed miserably. Oh, and by the way, you just waste a lot of time as well. So the idea here is stay diversified, and this isn't new. Stay 100% invested. Try to buy when the market corrects. And that's difficult because you have to go through enough bear markets to say, look, this isn't going to go away. We're already down 20 or 30%. If I start adding new money back in at this point, it may not feel good, but it's probably going to pay off over time. And usually it does if you stick to that. But the biggest thing that younger investors have that people like me don't is time. And if you can learn those traits and those skills early on, they really will pay for you. I didn't learn the lessons until I was in my late 30s. So a lot of time went by, and as you guys know, the power of compounding works every year. If I had learned that in my mid-20s, I would have done better. But look, as you're starting, especially if you have a bull market, you're patting yourself on the back like you're really, really smart. There are not a lot of smart investors during bear markets, right?
So you've talked about using ETF flows to understand market psychology. What do you think flows are telling us right now, and how should advisors be using that information in conversations with clients?
So every week that goes by and we hit new highs in the market or we're close to new highs in the market, it's been really, really hard to beat U.S. large cap growth. And when you see the few companies that make up the major market indexes, it's kind of crazy town. Like, you folks are looking at the statistics, and it hasn't been but for decades that we've seen so few stocks own such a large percentage of the capitalization of these major market indexes. People are going in and buying those individually as well, but it's hard to doubt the dominance. It's hard to say, I'm going to sell those now, because if you could have said that 5 years ago and you would have been wrong. At the same time, there are areas like large cap value, mid caps, small caps, international markets, even emerging markets. The valuations there are 20, 30, 40, 50% off what large cap growth is. And we know, just historically speaking, that the pendulum swings back. Eventually things come back to the norm. But if you're an advisor and you're diversified equally in all those areas, you've got clients that aren't too happy. So you probably have to cave a little bit, or you have caved a little bit over the years. And just if you're letting what you did have 10 years ago from a diversified allocation grow, you just naturally have more of a large cap US allocation. And even though 55% of global market capitalization is outside the US, it doesn't matter because clients over periods of time, they become less patient. So that's part of the dance that you're doing with asset allocation, talking to clients and making them happy. But I would also say when you look at, for example, international, and you look at the flows, international so far year to date is having net redemptions from ETFs, but international markets have outperformed US markets so far year to date. So what's it going to take for us to see maybe a tipping of the scales where we actually see flows start to come back, for example, in international? But the question is, do you wait till that happens and buy then? Or what usually happens is when the flows actually start really kicking in, most of the gains already been there. I mean, Rusty, you've been at this long enough. You know that it's nice to be able to look at international markets or emerging markets or small caps, but it's tough to pick on when they're actually going to be moving. It's got to be part of the diversified portfolio.
I totally agree. Absolutely. I mean, it's kind of like wearing the hat of an investment manager. You need to be different. You need to have a contrarian sensibility, but when you're an investment counselor and you're talking to your clients all the time, and you're trying to have that common ground, you kind of want to be with them. So it's kind of this disconnect between an investment manager and investment counselor. Classic problems we're going to be dealing with for the rest of our careers, and everybody listening to this, the rest of their careers as well. This episode of Invest Well, Be Well is brought to you by Main Management LLC, a pioneer in actively managed ETFs since 2002. Main Management starts with a clear fiduciary focus, delivering the transparency and personal attention you'd expect from a boutique firm. They provide financial advisors with solutions, not products. Main also believes investors should keep more of what they earn, emphasizing net of fee after-tax performance to help clients retain more of their returns. I've known Main Management for years. I've met thousands of managers over the course of my career, and one quality I really value: they invest alongside their clients. They eat their own cooking. Over 10% of the assets they manage are their own partner assets, and more than half of the firm are partners themselves. That says a lot. To learn more about Main strategies, including buy right hedged equity, U.S. sector rotation, thematic innovation, and all asset models, please visit their website at mainmgt.com. I want to talk a little bit more about asset allocation and portfolio construction. And, over the years, I've noticed some of the most successful ETF portfolios are also the simplest. Why do you think simplicity is often underrated by investors or even advisors?
You can get a ton of diversity in VOO and AGG, right? You can do 60-40, and if you just did that, you probably did pretty well. So let's just start with that. It's not as fun. It's definitely not sexy. You don't have anything to talk about on the golf course, but think about all the time you might have saved. From a fee standpoint, you're paying next to nothing. And I mean, look, Warren Buffett early on just said, just buy the S&P 500. And if that's all you did. However, we have an innate urge to not only make money, but to feel like we had something to do with it, to be smart. Our egos get involved. It's amazing what can happen if you just design a very simple few ETF portfolio and let it run and see what it can do. Now, that's not going to scratch the itch when you have that desire to pick a couple companies or pick a couple, as Balchunas would say, like spicy or hot sauce ETFs. So here's the solution. Of your total portfolio, pick 10% and just put it in another account. And that's your play account. And I've seen this work over time. In fact, I just had dinner with a friend of mine the other night who's fortunately retired. He did well. He sold a business. And he's so mad at his wife because he only has this small account. And he's so excited that he's done so well in the last couple of years. In fact, when that account becomes more than 10% of the overall, she goes in and she transfers money from that account and puts it back into the core account.
Yeah, nice.
But it scratches the itch for him. He can talk about it. And at the same time, if he's trying to pick stocks when the economy's bad or the market's bad, or he just, does poorly, he's not going to shoot himself in the foot. So sometimes it's little tricks like that, which will not only keep you on a path, but you won't waste time. I mean, I know people, Rusty, you know people that spend hours every day trading, and they don't have a lot to show for it.
I mean, what's the number? Like only 2% or 1% of day traders are successful. I mean, it's a tough game.
Yeah. I mean, I would prefer to put the time in being an opera singer. I think I can do it. I know some of the songs, and I could probably get more enjoyment out of that.
You know what? The next time you're on our podcast, that'll be our walk-up song.
All right. Yeah. Yeah.
So David Brooks, New York Times columnist and author, wrote a great book a few years ago called The Second Mountain, where he said the first mountain in our lives is attaining personal success and achievement, and the second mountain, as our intelligence, skills, and interests change, becomes more about purpose and meaning. So what does that second mountain look like for you personally and professionally?
That's a really, really good question, because it talks to where I am. I've actually been trying to jump from the first mountain to the second, and I've fallen down a couple times. So a little background, ETF Trends, which is the website I started in 2005, we merged with ETF Database. We ended up becoming Vetify, which was not only a investment ETF-based platform for financial advisors, but we also had an index business with that. Fortunately, TMX, or the Toronto Stock Exchange, in 2022 invested in our business, and in early last year, TMX bought the whole thing. So I had a wonderful exit and retired in April of last year. I have a personal coach that has been with me for the last 3 years, and we had a plan, and we pulled it out and said, okay, this is going to be it. And if we sell, this is what I'm going to do. So plans are always great until they're not great. Shortly after, my dad had been sick. I spent a lot of time in the Boston area with our family. We brought Dad in for a really nice landing, stayed at home the whole time. Family was around the whole time. But that was an important period of time, and I was glad not to be working. Shortly after, I got some tick-borne virus. It wasn't Lyme disease, but it was something like it, but it knocked me out for a couple months. And that was a tough thing to go through. Now, listen, I'm fine. It's not recurring. We got it early, but I feel for people who go through all that. So now we're back on the Jersey Shore, and my wife breaks her kneecap, and she's got to have surgery, and she's got a PT and stuff. So all these things, and things happen in threes, it would have been tough to deal with them if I was still working. But fortunately, I had the time. It also gave me, though, a chance to think about what was important. And what I realized back when I'm healthy and my wife's doing fine is I love the markets. I love the ETF space. I love innovation. I love building companies. And I really love the people that I've worked with over all the years. And I could think about other things to do, but I really wanted to stick around. So I had to find a way to stay involved with the ETF industry, building businesses, the people, kind of build Lydon 2.0. And what we came up with was, fortunately, made some money. The private equity firm that did our deal made some money, and we've been working together to find investment opportunities. Fortunately, last year, we invested in one of those synthetic income companies, Neos, and they've had a great run. I was an investor, shareholder way before then, way back when they started. I love what they were doing, and I put more money to work within their ETFs. And now I'm kind of like, the Hair Club for Men ad. I'm not only a shareholder, but now I'm an owner as well. So it's been a great experience, and we collectively are looking for other opportunities within the ETF space, white label offerings, distribution, and there's a lot of good innovation that's going on out there. My wife and I are lucky. We live on both coasts. We still have a place in Huntington Beach. We go back and forth. Our kids are good, and we get to see them a bunch too. So I kind of have the best of both worlds. I'm on that second mountain, Robin, and I'm just trying to hold on by my fingernails so I don't slip off.
Nice. So what would you say to other experienced professionals in finance who are thinking about that next chapter, that second mountain, and what that might look like, whether it's giving back, finding purpose, or building something entirely new?
Yeah, it happens a lot. I'm lucky because a lot of people reach out and they're saying, hey, I think I have one more gig in me. I've got some more gas in the tank. I've got this opportunity. I'm thinking I'd like to do this. And everybody's different. Everybody's goals are different. Everybody's skill set's different. But something that I find that's in common is if you feel like you've got 5 years left, look for something that you're going to be fulfilled. If you're good at building businesses, great. Try to find a way to partner or be a piece of something that's off the ground where you can make a difference. If you're not an entrepreneur, but you're really good at connecting people or opening up doors, whether that be sales or marketing or that type of thing, connect with a company that you can make a difference there as well. It's very, very important as you finally leave your working career to feel good about what you've done. And that's going to help you maintain those relationships as well. Plus, oh, by the way, end up making more money when you're really having a good time too. So that's really key and critical. But there's not a plan that fits for everybody. I just got back from a golf trip in New Hampshire with 8 college buddies. Most are retired. Some found it very easy. Some continue to struggle. Some retired and then went back and did something else. So you kind of have to find that happy medium.
You know, on a recent podcast of Invest Well, Be Well, one of our guests said that one should try to, this is depending on whatever chapter you are in your career, that you should spend 80% of your time in your genius. In other words, what you're interested in and what you're good at. So I thought that was really good advice. So we're now in the part of our podcast, which is about stronger living. And Tom, you have stayed energetic, sharp, and relevant in a fast-changing industry. What is your routine or mindset for personal wellness and performance, physically, mentally, and emotionally?
Thank you for that. I feel good. And that's the whole thing. Like, you know, if you want to be around to enjoy it, you got to stay healthy. My wife and I eat pretty healthy, but we're here on the Jersey Shore, Rusty, and it's hard, man. I mean, the pizza here is great. The Italian is great. It's hard to say no. We go out for dinner a lot, but I think one thing we'll find is we'll order a dinner and then I'll keep half and maybe have it for lunch the next day. Another tip I have, and I got this from my personal coach, is he asked me what I would have for breakfast. And down here, you know, they have these like sausage, egg, and cheese on the fresh rolls. And I would explain it to him. He said, yeah, you're not going to do that anymore. I said, what do you mean? He goes, do you have coffee? I said, yeah. What do you have in your coffee? I said, cream and sugar. He goes, you're going to have a coffee and you can put a little bit of cream in it. That's it. I said, that's it? He goes, yeah, that's it. And you can have a late lunch. It's like, what? He said, you're not going to know the difference. And within a week, I didn't know the difference. And it's not a big stretch. So it's not quite morning fasting, but that also does a lot. I have a really basic routine in the morning. As soon as I get out of bed and I put my contacts in, I do routine of push-ups, sit-ups, and tries. And that just gets my blood flowing a little bit. I can't say that I've lost all my gut, but I think it's helping. I walk a lot. We walk a lot on the beach. I play a decent amount of golf, and rather than driving in the cart, I'll get one of those push carts, and our crew that goes, we all do that together. So put on something there. I have been failing lately at the gym. We've had a lot going on, a lot of travel. I can always come up with excuses, but my daughter's getting married next month, and I got to get back there because I got to squeeze into a tux, and I'm a little concerned about it right now.
Action will be around forever. That's right.
I know. Another thing is being honest. I like having a cocktail from time to time. And about 4 or 5 years ago, we heard a lot about how much sugar there is in wine, and we like to cook. So we'd split a bottle of wine, and somebody said, you should try sipping tequila. And you and I have talked about this, Rusty. Like, I will get a small, glass of tequila with a couple of ice in it, and it's wonderful. It doesn't have as much sugar, and I think that's helped a little bit as well. So those things have helped in a big way is regarding the health. Look, I'm not out there on the treadmill running 10 miles. I wish I would. I'd like to gear up towards that. But right now, luckily, I think my genes are okay as well. One of the biggest things that's been satisfying is, as I've gone through the transition, my wife and I are enjoying where we are, and our kids are all in good shape. My wife and my kids and I have a quarterly meeting, and we go over kind of the family finances and estate planning, and we also have a family charter that we put together about 1.5 years ago. And we pull that out and we decide whether we want to add something to that or something like that. And basically all my kids and my wife and I, along with the accountant and the estate plan attorney, we're all on the same page. So if any of us got hit by a truck, we know exactly what would happen, and we don't have any concerns. But also, we all have a role in that. So, for example, we have different trusts for the kids, and each of the kid has a different brother or sister that's a trustee on that trust. And if they have any questions, they can ask each other, and they can work with the estate plan attorney and the accountant. So we're trying to, my kids are late 20s, early 30s. We're trying to teach them early on the importance of all this, and it's really working. And the cool thing that's come from it is, because we have these meetings, we don't have to spend family time talking about it. We get it all done, and then we push it aside. And when we're together, we just concentrate on family stuff. That doesn't mean that we don't fight from time to time, but we really just concentrate on allocating time for that and making sure that everybody's up to speed, and that's important. And then we don't have to worry about it.
There's so many words of wisdom in there. I really appreciate that. I love the idea of the family charter and meetings. I've known a couple different financial advisors that really encourage their clients to do that. One advisor in Arizona, very successful business. She has just a great business and almost 100% retention on all those assets, even when it moves to the next generation. So it's really good for the family, but it's good for the advisor too, right? So,
yeah, absolutely. I mean, we still have an investment advisory firm. It's more like a family office. But again, if I get hit by a bus, there has to be some of that transition stuff as well, and we've got a plan for that. It seems daunting, but once you get going, you kind of get everybody on the same page. And like, I'm really proud of it, but the kids and my wife are really proud that they all feel like they're up to speed on what's going on.
Yeah, great advice. All right, well, speaking of advice, what is one piece of advice that you've received, whether it relates to investing or life in general, that has really stuck with you through the years?
I was a big proponent of a Franklin planner. If you remember those, they were like the books. You'd have to write them down, scratch them out and stuff like that. I think the premise was great. I just, whether it's online or having a book, I don't do it, but my own version is kind of a to-do list. So I have a to-do list that I work off of all the time. Now, I'm embarrassed to say that this to-do list is about 120 pages. And I just look at the first 5 because I know that if I'm having a conversation, I can throw something in there, down below, and I know I can eventually find it if I can't get to it or if it's in the right place. But every day I'm working off of this thing, and it keeps me grounded. And especially as I'm later in life and not remembering everybody or everything, I have a chance to forget less and make sure I get stuff done. So first thing in the morning, I review the list all throughout the day. And by the end of the day, if there are things I need to do tomorrow, it's on there. it's a good little routine. And I'm surprised how many people don't have to-do lists, that they just try to look at their calendar or their memory, when in fact there's so many other things that are tied into that.
You say that, I have 3 different legal pads of to-do lists in front of me right here on my desk. I did have a mentor years ago back in Boston, Eric Coburn, who swore that a more effective mechanism is a got done list.
Oh.
Now, I have learned over the years he's usually been right on everything, but I still can't get away from my to-do list.
So how would that work? So it's a separate list, and once you get it done, it gets on the got done side?
It just has another list. This is just pull right down everything you got done that day, and he swears that you're even more effective. So,
because if by the end of the day you don't have a lot of stuff that you got done, you feel like, hey, I underperformed, I need to step it up.
It gives you the urge to just write stuff down, get it done.
Yeah.
Well, I'm going to piggyback kind of off of Robin's question. So I like the way she asked, like asking for one thing. But if you could offer one message to investors and advisors looking to invest well and be well, to live well, what would it be?
I think it's a summary of what we talked about today. Keep the portfolio simple. Don't day trade. Day trading is a time suck, and there's a great chance you're going to fail at it. And if you think about being day trading right now and you're a younger investor or a younger advisor, try to clock the amount of time you spend on that over the course of the week. And what if you had that time back and you could put it towards something that's really, really valuable, impactful? Maybe it's spending time with your family, spending time with something charitable, maybe just helping out other people. I feel like I do that to a certain degree. I feel that I spend little to no time on my own portfolio or my client's portfolio because I'm comfortable the way it's allocated right now. I spend way more time listening to what's going on to the markets, smart people, ETF flows, innovation, building businesses, and investing and creating portfolios, Rusty, as you know, it doesn't have to be complicated.
Well, Tom, this has been a great conversation. We really appreciate you coming on the show today. Before you go, tell us, how can listeners stay in touch and learn more about the work that you're doing?
So I've got a website, tomlydon.com, and you can also find me on LinkedIn. And then go over on YouTube to our podcast, Bangers Only. You'll see the one that Rusty and I had, and we might have repeated a couple of the things, but we also had a good time too. We talked about some new and fun things as well. But Robin, thank you for inviting me. Rusty, thank you. Thanks for the friendship. I'm really excited about all the things you guys are doing, and I know we'll be in close touch.
Well, thank you. I mean, this podcast is called Invest Well, Be Well. You are investing well, you are being well, and your words of wisdom here were really appreciated. Thank you.
Thank you, guys. Take care. Enjoy the rest of your week.
Yep, you too. We'll be back next week. Thanks for listening to Invest Well, Be Well. Let us know what you think, and if you like what you hear, don't forget to subscribe. This podcast is hosted by Rusty Vanneman and Robin Murray and produced by Garrett Crosby. Well, we'll be back next week. Thanks for listening to Invest Well, Be Well, and hey, if you like this episode, don't forget to subscribe.
If you have feedback, guest suggestions, or just want to connect, please visit my website, rustysbridge.com, or email me directly at rusty@rustysbridge.com. Until next time, invest well and be well.